Hello, everyone, and welcome to the Boyer Brief. My name is Mark Boyer. I'm here with Jason Jacoby. Hi, Jason. How's it going, bro? You going good?
I'm good, Dad. How you doing?
I'm doing great. I'm doing really well. I'm enjoying the summer. It's a little warm, but
Yeah,
this August, it's a great time of the year. So
absolutely.
enjoying it. So let's dig in. This is our topics to cover today in our Boyer Brief. We want to look at give you a market update, and where we are, what the markets are doing at the moment, to inflation reading for July. We're going to talk about recession or no recession, and then housing. Talk about the housing market a little bit, and then give us some silver linings coming out of where we are moment, so you can hear some of Jason and I's thoughts as we moving forward. So market update, Jason, we can double team this together. I'll just kind of give
Yeah,
you a quick Dow Jones. So far this year, Dow Jones negative 8.6%. You can see here on the screen. S&P down just over 11 and 12%. Nasdaq's down almost 18%. And if you've been following our briefs or the markets, you know that those numbers are awfully ugly, but they're not near as ugly as they have been earlier this year, even 6 weeks ago,
yeah.
8 weeks ago, much lower. Both markets were in a bear market, down more than 20% from recent highs in the last December. So we've recovered some in here, and so that's positive, but still, it's been a rough year thus far. Which, by the way, just as a reminder, we thought it was going to be a rough year coming into the new year. For a lot of reasons. And one is, midterm election year. It's typical for a midterm election year to have that, but more than, yeah. So it is what it is. That's where we're at now. We're liking the markets here currently. They've been bouncing in here and actually changing direction yesterday, which was really positive. So we're happy about that. I know I'll let you go through the barometer, Jason, but also on the note, you'll see the 2-year Treasury note at 3.21% and the 10-year Treasury at 2.78%. Now that's interesting because that's called an inverted yield curve, where the long-term rates are actually lower than the near-term rates, and oftentimes that happens as a precursor or a picture of us being in a recession or entering into a recession where the longer term rates are higher or lower, than the more near term rates. So that's just telling you that the market thinks inflation is going to remain high here in the near term, with longer term maybe coming down and so forth. So we'll see on that. But talk to us about this barometer, Jason.
Yeah. Thanks, Dad. So on the right-hand side, we have the last 12 months, kind of a nice U.S. market barometer here, showing on the y-axis to the left there, your small, mid, and large cap companies, going across again the y-axis, and then the x-axis at the top, the value, core, and growth categories. So your value companies, again, strong cash flow, great ironclad balance sheets, going nowhere companies, very defensive at times, can withstand different market cycles and can withstand, recession, depression type market environments. And then the core is kind of a blend. You get kind of your value and growth in one. And then your growth, obviously, think about like your tech companies, companies that are more focused on long-term capital appreciation rather than dividend payments or dividend growers. And again, they're kind of reinvesting their earnings into company innovation, product innovation, rather than paying the earnings out to the shareholders in form of dividends. So as you can see, that right side of the dark red there has been hit quite a bit worse than the value style companies. And again, that's normal, especially in the market environment we're having now. Again, more volatility on the growth side and style of equities. The value style, again, are kind of more slow and steady. Actually, over the long term, they do outperform all other types of equities. Look at dividend, growers and dividend companies, which is quite interesting, actually. But anyway, so just give us a kind of a breadth of the market right here and what's going on. But so it doesn't look too good, but we've recovered quite a bit, over 50% from the lows. But obviously, hot topic these days, the hot inflation numbers. Dad, What do you think? What's going on
Yeah, and then
here?
just on that last one is just that, remember, that's a 1 year look. So
Hmm.
if we went 3-5 years out, that those numbers would be much more in the green, and the
Hmm.
growth is especially over 5 years, has really outperformed. But it just shows you
Yep.
what, one of the reasons why an all-weather portfolio is having allocations. Most of you with in our portfolios, you have access, and we have little bits in each of these areas and so forth, and then we're adjusting that to try to take advantage of it. So anyway, that's interesting, and it's again, but that's a short-term look at the markets, which if you're in the markets, just a reminder, always taking a long-term look. But we want to show you this in the short term of just what's happened. It's been brutal for the growth stocks for sure.
Hmm. Absolutely.
Inflation. So inflation's been the talk of the day everywhere you go, every, news channels, go to Costco, you go shopping, it's crazy. Inflation's at a 40-year high, which we all know. You see there on the far chart, the consumer price index, 12-month change. You can see that it was since early 1980s that we've been this high. The July reading just came out this a couple of days ago, actually, and 8.5%, and which was pretty even to the month before.
9.1, yeah.
The good news then was gas down 7.7% the last month, which everybody's excited about. But as you can see in the middle chart, I mean, that's down from almost a 60% high, going from 2021. So it's a little retreat, but not a whole lot. The good news is the core CPI contracted for the second consecutive month. So a lot of folks are betting and believing, as we are, that maybe inflation has peaked in the near term, for sure, and going to not go. I think inflation's here to stay, but for a while, especially a little higher inflation for sure, but it's at least adjusting and not going higher. That's been actually good news when it doesn't go higher, right? So,
Yep.
But you can see there grocery prices are up 1.3%. They rose 13% from the year prior, and that's the fastest annual pace since 1979. So again, was at Costco the other day. It's just amazing to see, how expensive everything is. And one thing I notice is that people just have less items in their grocery cart than they typically have. So everybody's being more selective, trying to be smarter with how they spend their money. And that's the adjustment that the consumer makes in these kind of environments, and part of the economy. And as people adjust, prices will adjust too eventually. And that's kind of how this, the economy works. Even corporations are doing that right now, trying to figure out what they need to cut and do to keep their earnings going and keep their sales happening, things like that. So it's kind of like a halftime adjustment. We're all doing that. We're all figuring out what our budgets can afford, and then we're making those adjustments. So that's a process that takes a little while, and we'll see how it continues to play out.
Absolutely, absolutely. So that leads us into the question, right? That's kind of the age-old question here that we've seen on all news networks. Obviously, are we in a recession? Funny thing is, depending on which news network you watch, some say yes, some say no. But we need to first define recession before we begin talking about numbers and things like that and what we're looking at here. So, recession, the way we learned it, was 2 consecutive quarters of negative GDP. A depression would be 6 consecutive quarters of negative GDP. That's a depression. So are we in a recession? Based off the definition, yes. There is a broader definition that the Labor Department does like to look at. And again, I don't think this is a normal recession, right? There's just because our economy's been propped up for so long with all of that synthetic money being pumped into the system. So things might take a little bit longer to play out in terms of, you're looking at unemployment, you're looking at, again, the jobs created this past month in July. I think we created over 520,000 jobs, approximately, give or take, which obviously the markets rallied on that news as well. But if you look at the unemployment numbers that came in, 3.5%, which is, again, pre-pandemic numbers, but over 500,000 people have not returned to the labor force again. And I think it's just with the weird time that COVID kind of brought about, there's been a lot of irregularities in the system, and I think you would agree with that. Is that it's kind of inflated a lot of numbers, and things aren't indicators aren't flashing like they normally would, or they are, but it's kind of lagging. Again, so if you look in recession, is it bad, Dad? Obviously, recessions aren't a good thing for the consumer, but it does help the reset of the economy, lower that inflation number, which we talked about earlier. Hopefully, getting back to 2%, which again, I think you would agree we probably won't get back there for quite a bit of time. Look at the last 90 years. Was it 4%, right?
Yeah, it's been an average of 4% a year over the last 85 to 90 years. So I look to eventually, if we can get to 4% inflation, I think that would be a big that would be a big win, and more historical averages. But we'll see. I mean, this whole economy has been really. I mean, think about the pandemic, right? So we came out of a pandemic. People were, shut up in their homes and so forth. So they're coming out. We've opened up now. People are wanting to get out. They want to do things. They traveling services. They're, blah blah. I mean, there's just this summer. I mean, everybody's enjoying they're trying to get out. So even though the inflation numbers are big and there's these issues out there, I think because of that pent up demand, they're just going no matter what. Like, hey, I'll pay the piper later, right? So that'll be interesting coming into the fall now as summer goes by, to see how now people begin to pull back, if it is tight, and that's when you might see less spending, especially on discretionary goods, and more people are liking the service part, the movies, the trips, things like that. So we'll see what happens, but we're definitely, I thought maybe the recession wouldn't be until, I said earlier, another Boyer brief, that maybe it wouldn't be until late this year, next year, but clearly it's, I think we're going to be into it for a little bit here. And clearly based on the description, the last couple quarters, we have been in a slight recession, but it's not a bad thing. Okay. Recessions are normal in an economic cycle, and actually, again, they can be they're good actually, and we'll show a chart here in a little bit, because again, in that adjustment phase, as everybody slows down and adjusts, both consumers and corporations, they get lean and mean, they cut things back, and then that sets up the next cycle to the upside. So so it's a process, and we just don't know how long that process will take. So that's more of the question.
Yeah, I think an average duration, according to Bureau of Economic Analysis, we're looking at an average duration of about 10 months for a recession, negative GDP contraction of 2.5%. So again, we're right there. We've had 2 negative quarters according to that chart, one in the top left-hand corner. And what's kind of concerning, again, the unemployment's low, but companies are starting to trim the fat, starting to lay off workers. LinkedIn, Microsoft, a lot of companies around the United States are doing that. But also over 230 million credit cards were opened in the first 2 quarters of this year, which is a cause for concern, to me at least, that people have run out of kind of their pandemic savings, or are running out of it, and they're preparing to use credit again. Which is not a good sign, because debt in that aspect is not good. So we'll see how that plays out.
And to my point, like, that's what I'm saying. Coming out of the pandemic, it's like, hey, look, I got to get out. I got to go do things. I'll use my savings. I'll, maybe throw some money on a credit card and deal with that later. So at some point, that's going to run out, and then I think the reality is going to hit, and that's where I think the consumers will even more so kind of pull in. So. We'll see how that goes.
Absolutely. And we've seen, obviously, we talked about this the other month in one of our Boyer briefs as well, right? We talked about housing, cost of goods is increasing for producers. The housing market's obviously been on an incredible run, right? I mean, your home values increased quite a bit, especially where we live, right in Orange County. It's just insane. But all over the United States, even, a lot of people moving around different states. Florida, the Carolinas, Tennessee, Texas, a lot of places around the U.S. have seen incredible spikes in home values. So what does that mean? I mean, is that a precursor for quite a big price correction here, Dad? What do we think here moving forward?
I think there's there's, obviously when interest rates go up as they have, and they're going to continue to go, Fed's going to continue to raise rates again. I mean, mortgage rates have, gone up significantly. So the cost of borrowing just, gets a lot higher. And that part of it, when you have interest rates that have been so low the last 15, 20 years, it's really fed this housing boom. And so again, back to longer term trends, it makes sense that, that the housing market would slow down, and that there would be a pullback on the price of homes and or anything around real estate. It's going to be interesting. I know my real estate friends, people who are sort of in the know, they're really being very cautious in here. And even keeping their powder dry for an opportunity to pick up things that either depress loans or whatever, right, that might happen in here. So it's a cycle. I mean, these cycles happen in in a country like ours with capitalist system. It's the up and downs of things. So we can't stay at these heights forever. We're definitely going to pull back in here. It'll be interesting to see how far that goes.
Yeah, absolutely. So just to cap that off here, obviously single family home purchases fell by 8.1% last month, which is the biggest drop in 2 years. And also sales of previously owned homes fell 5.4% for the 5th consecutive month. So just playing into that, again, people are being more cautious. There's more supply, going to be less demand. It used to be a seller's market when inventory was so low. Now, from what I've heard again from our real estate friends, is the market's kind of moved more neutral, and then it's to be seen, where that goes from there. But again, something we're watching, something we're talking to our real estate professionals about, but something to keep an eye on about how bad this could actually become.
And we'll talk more about that going forward as well. So.
Mm-hmm. Yeah. So
silver linings, Jason.
You got it.
Some of the things we see here going forward, some of the positive aspects of here in the next few months.
Yeah, absolutely, Dad. So as football players, as a tight end, you went over playbooks. There were, a game plan for what to prepare for and how to beat the other team, right? How to beat the enemy. So with that being said, I think in terms of silver linings, yes, we're in the midst of a recession, or if you don't believe so, we're tipping into one at least. So with that being said, we do think inflation should continue to tick down over the second half of this year and into next year. Again, we mentioned earlier in this video, will it go down to 2% like Jerome Powell and the Fed want it to? Probably not anytime soon. If we can get it back to 4%, that's a victory in itself. But a recession will potentially reverse extreme inflationary pressures that we're currently feeling, that our pocketbooks are feeling a little bit, and slow demand for goods and services. So, and something that Dad, you and I have been preaching for a while now. What kind of stocks do we like? I think we're both in agreement on this.
The high quality, dividend growth kind of style is our favorable place. We think dividends are key. Dividends come from companies that are well established, that have profits, that instead of putting necessarily the profits into more growth of their company, although they're doing that, but they're also have decided as corporate boards and so forth to actually pay those profits back to the shareholders in either annual, quarterly, monthly dividends. And so those, especially when you're reinvesting them possibly into more shares, or getting that working for you, is a really positive thing. So we like the fact that we like the ideas of owning dividend paying stocks in here too. And I think as that barometer you showed earlier showed that's been a really benefit, especially in down markets. But there's still a place for growth stocks for certain investors and so forth. I mean, if you see this rally that's happened in the last 6 weeks, I mean, the growth stocks have really rebounded quickly. But longer term, and again, in a balanced portfolio, we like the high dividend paying stocks as well. So places that are healthcare, software, insurance companies, even consumer staples. I think stock selection is really important here. That's why we're We like the managers that we use. I know they get good research and so forth, but I think it's really important to have good management going on in the companies that we're owning and also deciding to own. So that's really important. And then, recession, again, what we said earlier is recession doesn't necessarily equal a catastrophe. It could still be a mild recession. There's multiple factors at play. But like I mentioned earlier, it's the recessions are normal part of an economic cycle that although painful, markets are already, they typically adjust, they factor those in months in advance, which we're not sure that didn't happen in the earlier part of this year. So we're not sure if this is a bear market rally or actually got some legs to it, because markets usually adjust ahead of time in anticipation of something that's going to happen 9 months, 12 months out. But the idea is that the recession, in this period of time where companies and consumers, everybody's adjusting, it can be painful, but it sets up the next, next ride, because you get lean and mean, fighting machines, right? I mean, you trim the fat of what you do, you focus on your priorities and cut the things that, aren't helping you get there. And so as that works its way through, it creates an opportunity for the future big time. So
absolutely. And like we've been preaching, all weather portfolios can thrive in a variety of market conditions. That's what we try to do, depending on our clients' goals and objectives. But I think that's key right now, especially in this market. A lot of factors at play: midterm election year, potential, or even that we're in a recession, right? So it's important to not get overweight in one specific sector or equity style, that we invest in different asset classes and equities. Even bonds now are paying some nice interest, right? It's a good time. Potentially it becomes a more valuable asset class rather than just diversification. It can actually pay a decent stream of income now. So again, different options, different things, all stuff we looked at, but having an all-weather portfolio can help smooth out volatility curve. So before we go, Dad, I think we kind of led into this here. Recessions are painful, but they are less impactful than expansions. So if you take one thing from this 22-minute video here, again, we wanted to get you this information in video format with a little bit more in depth than the text that will be below in the bullet points in the newsletter. But if you look at this chart here on the left, okay, the blue is the average expansion. The average expansion lasts about 69 months. The average recession lasts about 10 months. Okay, it's the purple on the chart there. GDP growth 24.6% for the average expansion. Average recession, a GDP contraction of 2.5%. And then net jobs added, about 12 million jobs in expansionary phases, and then an average loss of jobs, unemployment of about 4 million almost in the average recession. So obviously recessions are painful, but expansions are way more impactful. So keeping perspective of the length, the duration, the severity of these things when you're investing, and even in your goals, right? When we're doing the financial planning process, these are things to factor in. So any last words, Dad, before we wrap up this month's Boyer Brief?
No, I think we nailed it. Again, take a longer term approach. Always we talk about that. I mean, when you look at these numbers right here, you're talking, the pain is never fun. And 08, 09, we had some times where it's been really, really painful. This one, where we're in now has been painful this year. And it could be worse. It could get worse. We're not really sure yet. We see a lot of factors like we talked about, but there are hopeful signs, especially longer term. If you keep your long-term perspective, you could see there that if the average recession's 10 months, the average expansion is almost 7, 5, 6 years. It's a long time, right? It's a big, and that's a huge benefit that if you don't ride through and keep your game plan, it can really affect your performance longer term. So anyway, have a plan, call us, if there's things that's changing, if there's situations that have happened that you need to talk about, please let us know. But let's keep moving forward, and we're very positive for the future, longer term for sure.
Absolutely. All right. Well, Dad,
thanks, Jason. Good being with you.
Fun. All right, guys. Well, we'll see you next month. for September. Holy moly, your birthday month. What are you turning,
Oh,
40?
man.
Birthday month
Yeah,
here.
40 plus 20. I'm getting 60 this year, bro. That's a whole
Whoa,
different.
I love it. Hey, at least
Yeah.
you're honest. Looking younger every year. But thanks everyone. God bless, and we will see you next month. Have a good one.